When you hear the term hedge fund, you might picture billion-dollar portfolios, Wall Street power plays, and high-stakes trades. But, behind the prestige and complexity, hedge funds operate on a set of disciplined investment principles. Principles that everyday investors can actually learn from and apply to personal financial planning and asset allocation. In a world where financial markets are increasingly volatile and diversified income sources are more essential than ever, understanding how hedge funds think about risk, return, and diversification can offer valuable insights for your own portfolio. What is a hedge fund, really? At its core, a hedge fund is an actively managed investment fund that uses a variety of strategies to generate returns for its investors, often with the goal of producing positive returns regardless of market direction. Key characteristics include alternative strategies. Hedge funds can invest in equities, bonds, currencies, commodities, derivatives, and private equity. Risk management. The term hedge comes from the idea of managing downside risk, even when pursuing aggressive returns. Performance focus. Unlike index funds or traditional mutual funds, hedge funds aim for alpha, return above the market. Translating hedge fund wisdom to personal finance might sound a bit intimidating at first, but don't worry, it's actually quite approachable. You may not have a team of analysts or access to exotic derivatives, but you can absolutely use hedge fund principles to improve your financial health and build a more resilient investment portfolio. Hedge funds, well, they don't put all their eggs in one basket. And that's a strategy personal investors can learn from. Instead of sticking to just the traditional 60-40 stock-bond split, consider expanding your horizons. Alternative investments like real estate, REITs, commodities, think gold, and even cryptocurrency can all play a role in shaping a modern, well-rounded portfolio. And don't forget geographic diversification. Adding exposure to international markets can open up broader growth opportunities. It's all about spreading your risk thoughtfully. So here's the key takeaway. Don't rely on a single asset class. Instead, spread your risk across different sectors and geographies. It's a simple but powerful way to build a more secure financial future. Hedge funds often prioritize risk-adjusted performance. It's not just about making money, it's about making money consistently and with manageable risk. Tools like the Sharpe ratio, or if you're feeling a bit more advanced, the Sortino ratio, can help you assess the quality of returns in your own portfolio. And hey, avoid chasing high returns without considering the volatility that might come with them. Here's the takeaway: a smooth, steady ride beats those wild ups and downs. So focus on risk efficiency, alright? Unlike passive investors, hedge funds dynamically adjust their exposure based on factors like economic outlook, interest rates, inflation, or even geopolitical risks. Now, as a personal investor, you might want to periodically rebalance your portfolio to keep it aligned with your goals and the realities of the market. Oh, and don't forget to adjust your allocations when major life events occur. Things like a job change, marriage, or even retirement planning. So here's the takeaway. Your financial strategy shouldn't be a set-and-forget approach. Honestly, staying proactive is key. Let's talk about the use of hedging techniques. Hedge funds often rely on strategies like options, short selling, or even currency hedging to protect against losses. Now, you can apply a similar mindset too. For example, consider using stop-loss orders to safeguard your gains. Or you might look into inverse ETFs or even cash positions as a buffer during down markets. And here's another thought. Insurance, like term life or disability coverage, can actually work as a hedge against personal financial shocks. It's all about preparing for the unexpected. Liquidity and time horizon management. Let's break it down. Many hedge funds, lock up investor capital for months or even years. Why do they do that? Well, because long-term strategies, they just take time to play out. Now, when it comes to personal finance, it's really about matching your investment types with your goals. For an emergency fund, you'll want liquid cash that's easy to access. For short-term goals, think about bonds or CDs. And for long-term wealth building, that's where stocks, ETFs, or even real estate come into play. It's all about aligning your investments with your timeline, really. So here's the thing. Understanding your own liquidity needs is absolutely crucial before you start chasing those higher yield opportunities. Alright, here's the key takeaway. Don't tie up money you might need soon in illiquid or volatile assets. Seriously, it's just not worth the risk. Let's bring it all together now. A hedge fund-inspired personal portfolio. Here's a simple framework, inspired by hedge fund thinking, that you can actually use. First, we've got core growth. Think index funds and blue-chip stocks. The purpose here? Long-term capital appreciation. Next, defensive assets. These would include bonds, dividend stocks, and defensive ETFs. They're all about providing income and protecting against downside risks. Then we have alternatives. This could mean REITs, commodities, or even Bitcoin. These are great for diversification and acting as an inflation hedge. Moving on to tactical plays, sector ETFs, thematic funds, or options. These are targeted growth opportunities designed to give your portfolio a little extra edge. And finally, cash and liquidity. High-yield savings accounts and money market funds fit this category perfectly. These are here for emergency needs and to keep your portfolio flexible. Alright, let's wrap up with some final thoughts. Think like a hedge fund, but live like an individual. You don't need a finance degree or millions of dollars to borrow the mindset of a hedge fund. By diversifying smartly, managing risk, staying flexible, and protecting your downside, you can actually build a personal investment strategy that's just as strategic, if not more sustainable, than many institutional funds. Remember, financial success isn't about beating the market. It's about building a portfolio that works for your life.